Hello friends, welcome to Policy Pulse. In this episode, we discuss about Canada's debt trap. Canadian households are the most indebted in entire G7. Not second, not third, number one. At 103% of GDP, we owe more relative to other economies than Americans, German, British, Japanese, French, and others. And if you live in Toronto or Vancouver, I'm sure you already know, buying a home now requires roughly 4 years of your entire gross income just to save the down payment. And of course, that depends on how much money you make. So, today's question is simple. Is this debt economy? Who is actually winning and who is quietly paying the price? My name is Jewel and this is Policy Pulse. So, as you can see from the chart, to understand this, we need a bit of context. Household debt as a share of GDP is the single most useful way to compare countries because it tells you how much families owe relative to the size of entire economy. Canada sits at 103%. The UK is at 85%. United States, despite everything we hear about American debt, is at 76%. Germany is at 57%. Italy is at 43%. Canada is not just ahead of the pack, we are in a different zip code, so to speak. This didn't happen overnight. From 2008 through 2022, the Bank of Canada kept interest rate near zero. Cheap debt flooded into one of the most land-constrained housing markets in the world, while we do have plenty of lands, more than any other countries. Prices went vertical and Canadians borrowed to keep up, first to buy and then to renovate and then to just to afford to rent. Then in March of 2022, Bank of Canada started raising rates, then hikes in 16 months. Policy rate from 0.25% to 5%. The era of cheap money was over, but the debt it created wasn't going anywhere anytime soon. Now let's put some numbers on the scale of this. Statistic Canada puts total household debt at $2.4 trillion. That's a trillion with a big T. The Bank of Canada tracks what they call the debt to disposable income ratio. As of late 2024, it sits at 184%. That means for every dollar Canadian take home after tax, we collectively owe $1.84. In Toronto, the average home now costs about $1.1 million. Standard down payment 20% is about $220,000. At a median household income of around $75,000 gross, you need nearly 3 years savings every single dollar you earn to hit that number. Realistically, and factoring in taxes and rising living costs, you're looking at 4 or more years of dedicated savings. In Vancouver, it's even worse, as you already know. This is not a housing crisis, it's a wealth access crisis. Some people are doing very well today's economy, and it doesn't matter how much is the housing price, it doesn't affect them. So who is winning? Here's where it gets interesting. Because Canada's debt economy isn't destroying value for everyone, for a specific group of people, it has been one of the greatest wealth building machines in history. First, the boomer homeowners. Canadians who purchased property before 2015 have seen their net worth explode. The median net worth of Canadian 65 and over is now over 545,000 estimated, and the overwhelming majority of that is housing equity. Many of this group own multiple properties and are now collecting rent from the very generation that can't afford to buy. Second, Canada's big six bank, RBC, TD, Scotia, BMO, CIBC, National Bank collectively posted over $58 billion in profit in 2023. Mortgages are their primary revenue engine. Higher home prices means larger loan balances. Higher interest rate means fatter margins. In Canada's regulated banking oligopoly, the debt boom has been enormously profitable. Third, the real estate industry. Think about it. The realtors typically earn 3 to 5% commission on a $1.1 million Toronto home, for example. That's about $33,000 or more per transaction. Add lawyers, mortgage brokers, home inspectors, appraisers. The industry ecosystem generates tens of billions in annual fees. Obviously, they're very happy. And fourth, this one surprise people, or I should say, this might surprise the people, all of you, provincial governments. Ontario's land transfer tax, also British Columbia, huge, I guess, income from property transfer tax, combined, in this case, Toronto's own municipality layer, now exceed 44,000 on average Toronto home. Higher prices means automatic revenue increases with no need to raise rates. And of course, those increased revenue doesn't really flow through a better services to the city or to the citizens. Now let's look at who is losing. Now for the other side of the ledger, the millennials, the Gen Z are effectively locked out. The home ownership rate for Canadians under 35 has dropped from 44% a decade ago to 36% today. A 2024 RBC Economics report documented how the under 40 cohort is delaying marriage, delaying children, having children, and raiding retirement savings just to keep up with the rent or to chase down a payment that keeps getting farther away. Canada's 13 million renters are also losing. One third of Canadians rent since 2020. Average rents have climbed nearly 30% or more. In Toronto, a one bedroom average is about $2,400 a month, and some parts in Vancouver it's even more. When rent to income ratio exceeds 40%, which they now do in many Canadian cities, that's officially housing stress. You are working primarily to pay someone else's mortgage. Then there is the statistic that almost nobody connects to housing policy. Canada's birth rate in 2023, it hit about 1.33, the lowest on record. Statistic Canada surveys consistently cite housing affordability as number one reason young Canadians are having fewer children. The long-term fiscal cost of shrinking tax base will far exceed any short-term gain from elevated property values. And finally, new immigrants. Canada brings in over 500,000 new permanent residents per year. We recruit them because we need their skills and their labor. That's the argument that government and political parties and some businesses want you to believe. And then we drop them, once they come here, into a housing market like Toronto, Vancouver, where most will spend their first decade renting, unable to build any equity, while the wealth gap between established and newer Canadians quietly widens. Now let's look at the $900 billion time bomb. Here is the part that genuinely worries economists and hasn't gotten nearly enough attention. During the COVID, Canadians locked in mortgages at historical low rate. The most popular choice, a 5-year fixed rate as low as 1.75%, monthly payment that was felt manageable by many Canadians. Those 5-year terms are now coming due between 2025 to 2027. Approximately $900 billion worth of Canadian mortgages will need to be renewed. Run the math, as you can see. A homeowner with $600,000 mortgage balance locked in at 1.75% in 2022 was paying roughly $2,500 a month. At a renewal rate of 5%, that same mortgage costs $3,500 a month. That's over $1,000 more every single month with no change in the size of the mortgage. Even if Bank of Canada cuts rates further, renewals at 3.5% to 4% still represent massive payment shocks for households that budgeted 2020 level. This isn't speculative, it's a mathematical, and it can be easily understood. The question is whether those households can absorb this hit, or whether we start seeing a wave of forced sales and credit distress that ripples through the broader economy. Although, due to other international changes, the interest rate has been reduced currently, which is most recently is unchanged. Bank of Canada hasn't really raised or decreased the rate. So those are unpredictable situation, and due to war in Iran and the oil market being a hostage due to Gulf of Hormuz situation, what is yet to come is unknown. So now let's look at the policy options available to Government of Canada. So what the Canadian government is doing right now about this? Ottawa has extended a 30-year amortization scheme to first-time home buyers to build or purchase new homes, and that lowers monthly payments. But it also means paying more interest over the life of the loan, because if you increase the amortization, you are paying more interest, and it's a trade-off, of course. The First Home Savings Account, or FHSA, lets first-time buyers save $8,000 per year tax-free, up to $40,000 lifetime. Combined with our RSP Home Buyers Plan, a couple could easily access up to $150,000 in tax-sheltered savings towards the down payment. It's helpful, but a fraction of what's actually needed in Toronto or Vancouver market. And not too many people, Canadians, have that type of savings or money available to contribute to those plans. Anyway, the foreign buyers ban, in place since 2023, restricts non-Canadians from purchasing residential property. Its actual impact on prices has been modest. Foreign buyers were never the primary driver, and also foreign buyers are quite smart. They always find a loophole to get around this law. They buy through their friends, family, and children who comes to Canada for education. So there was a anecdotally or reported in the media plenty of a story like that. Anyway, critics say the real problem is supply. CMHC estimates Canada needs about 3.5 million additional housing units above baseline construction by 2030 just to restore affordability. The federal housing plans targets 3.87 million new homes by 2031. But that requires provinces, municipalities, and the construction industry to move faster than they ever have. And the analysts like those at the City Housing Institute point out that demand-side subsidies, grants, tax breaks, incentives for buyers can actually push prices higher if supply doesn't keep pace. You can't solve a supply problem by giving people more money to chase the same limited number of homes. So, which is totally understandable and true. So here's the bottom line. Canada's household debt problem isn't just an economic imbalance, it's a wealth redistribution machine. Every year that housing prices stayed elevated and the ownership remains out of reach, wealth flows from those who are renting toward those who are already holding assets. The winners, the boomers, banks, real estate professionals, lawyers, government, benefit from the status quo. The risk bearer, millennials, renters, young families, new Canadians, they all absorb the cost. And that $900 billion mortgage renewal cliff that I mentioned earlier, it means the real financial stress of this era is just beginning. The real policy question isn't whether Canada has a debt problem, it's whether the people making decisions will choose to fix it, or whether the incentive structure they operate within makes the status quo too profitable to disrupt. And there are many other factors involved. The mainstream media never talks about the real issue. They always gloss over. They bring some so-called expert who represent the real estate industry, who represent the banks, mortgage brokers, lawyers, and the so-called expert from the universities who doesn't really have any issue with buying their own property. Obviously, they're all well-to-do. They don't really live in the real world. You and me, we live in the real world. We know what the real story is buying a affordable housing in Toronto, Vancouver. Thank you, and I'll see you in the next episode.